everyone. Let's talk about accounts receivable here for a few minutes. So accounts receivable are monies owed to us from our customers. So they buy one of our products and we extend credit to them, allowing them to pay us in, say, 30 days or 60 days, whatever it might be. The problem with accounts receivable is that inevitably, if we extend credit to other people, that somebody isn't going to pay us. So in order to make sure that our financial statements are accurate, we need to set up some sort of way to account for what those amounts that we expect will become uncollectible. So in our balance sheet, typically we will see our accounts receivable reduced by an allowance for bad debts. So that will give us net realizable value. So the amount you see on your balance sheet should be the amount that we expect to receive from our customers. And there's a few ways we can calculate that. Through past history, we will know on average so many customers don't pay, or perhaps our industry will have an average, something like that. So we can use that to set up an allowance for bad debts. So at the end of every accounting period, meaning at the end of every month or the end of every quarter or every year, whenever it is we prepare our financial statements, we need to estimate how much of our sales will become uncollected. So out of the sales that we make during that period, we want to be able to match a bad debt expense against those sales in the same time period as an estimate of the amount that we believe will become uncollectible. We can't actually write them off until they become uncollectible, which will be sometime in the future. But again, so our financials look accurate, we want to go ahead and make an allowance for the amount we think will go bad. So at the end of an accounting period, we will make an adjusting entry. So we will debit bad debt expense. So that's an expense that will hit our income statement. So our expenses will go up for that, and we will credit this allowance for bad debts. Now it says here it's a contra asset account. And what a contra asset account is just an account that it carries a balance opposite of an asset. So it will carry a credit normal balance, and debits then will actually decrease an allowance account. So then when an account becomes uncollectible, what we are going to do is we will debit the allowance for bad debt expense. Again, we will reduce it. And then we will credit the customer's accounts receivable account. So that's how we would actually write off an account under the allowance method. Now there's two ways that we can estimate the amount that's going to become uncollectible. One is called percentage of sales method, and the other is an aging of accounts receivable. So percentage of sales is quite straightforward. We'll take the current period sales, multiply it times some sort of bad debt percentage. Again, that's probably best determined by history or industry average, and that will give us an estimated bad debt expense. So that's the amount that will be debited or credited, to our allowance account and debited to our bad debt expense at the end of the accounting period. And here's an example of what an aging of accounts receivable would look like. So again, we would have so many accounts that are not yet due, and we would determine what percentage of those that are not yet due typically become uncollectible. We'll look at how many are 1 to 30 days past due and see the balance of those and determine how much of those typically become uncollectible, and we'll get an uncollectible amount there. And then we'll do that for everything all the way to over 90 days, and then look at the amounts that are over 90 days past due. And typically the longer a balance is outstanding, the less likely you are to collect on it. So you can see the uncollectible percentages get considerably higher as we extend. And then we will just add up all those amounts. That would then become the amount that we need in our balance for our allowance account at the end of the period. So hopefully that clarifies things for you here a little bit. We can do the same thing with a notes payable, and I'll do a little video to cover that here in a second. Thank you.